What's up, everybody? Welcome back to another episode of Level Up Finance. Today we've got some breaking news to share with you. In recent weeks, companies like Tesla, Apple, and Amazon have made headlines with stock split announcements. But what exactly is a stock split? Why do companies do it? And what does it mean for you as an investor? Let's break it down. Welcome back to Level Up Finance. I'm your host, and this is your daily update on money, business, and success. So let's start with the basics. A stock split happens when a company increases the number of its outstanding shares by issuing more to current shareholders. But here's the key. While you get more shares, the total value of your investment doesn't change. For example, if you bought one share of stock at $1,000, and let's say that company did a 2-for-1 stock split, well, after the split, instead of having one share worth $1,000, you'd have two shares worth $500 each. Now, this might seem a bit complicated, so let's try that again with a different example. Now that we've got the basics down, let's explore why companies decide to split their stock. As mentioned earlier, several major companies like Tesla, Apple, and Amazon have recently announced stock splits. These splits aren't just random occurrences. They are carefully planned strategies to address specific challenges the companies face. One of the primary reasons companies opt for stock splits is to make their shares more affordable and accessible for retail investors. For instance, before its 2020 stock split, Apple's share price was around $400. This high price point could be a barrier for many individual investors who might want to buy Apple stock but are deterred by the cost. However, after a 4-for-1 stock split, the share price adjusted accordingly and became more attainable for a broader range of investors. Similarly, Amazon underwent a 20-for-1 stock split in 2022. Prior to the split, Amazon shares were trading at nearly $3,000, making them less appealing to retail investors. By offering more affordable shares after the split, Amazon opened up its stock to a larger audience. Another reason for stock splits is to increase liquidity. Liquidity refers to how easily a security can be bought or sold without significantly impacting its price. When a company splits its stock, the number of shares available for trading increases. Take Tesla, for example. The electric car maker implemented two stock splits in 2020 and 2022. These splits not only made the stock more affordable, but also resulted in more shares being available for trading. Higher liquidity can lead to increased trading volume, which can further boost a stock's popularity among investors. Stock splits can also be driven by psychological factors. Investors may feel more inclined to buy a stock if its price is lower and more manageable. For example, if an investor sees that a company's shares are trading at $10, they might feel more comfortable buying 10 shares compared to buying one share at $100. This psychological effect can make stock splits appealing to companies as it might attract more investors and potentially increase trading activity. Finally, a stock split can signal confidence in the company's future prospects. When a company decides to split its stock, it usually indicates that the company believes in its long-term growth and value. This positive outlook can boost investor confidence and contribute to an increase in the stock price. Now that we understand why companies perform stock splits, let's talk about the different types of stock splits and their impact. There are two main types of stock splits: forward and reverse. As covered earlier in this video, a forward split is the most common type where the company increases the number of shares and reduces the price per share. On the other hand, a reverse stock split is less common and involves reducing the number of shares and increasing the price per share. Reverse stock splits are often used when a company's share price falls below a certain level, such as $1 per share, to prevent delisting from major stock exchanges. Now let's look at some real-life examples of stock splits. In 2020, Apple Inc., the tech giant behind products like iPhones and iPads, announced a 4-for-1 stock split. At the time, Apple's stock price was soaring, but a split allowed more retail investors to participate in the market. After the split, Apple's shares became more affordable and attractive to a wider range of traders. Similarly, Tesla Inc., the electric vehicle manufacturer known for its innovative designs and technology, implemented two stock splits in 2020 and 2022. Both splits were 5-for-1, aiming to increase accessibility and liquidity for its stock. These stock splits generated significant attention from the media and investors. Lastly, Amazon.com Inc., the e-commerce giant with a vast online marketplace, completed a 20-for-1 stock split in 2022. Prior to the split, Amazon's shares had climbed to almost $3,000, making them unaffordable for many individual investors. The stock split brought the price down to a more manageable level, allowing more people to invest in the company. Now that we've seen how stock splits work and examined some real-world examples, let's discuss the pros and cons. Stock splits offer several potential benefits for investors. Firstly, they make stocks more affordable by reducing the share price. Stock splits allow investors to purchase more shares, giving them greater exposure to a company at a lower cost. Secondly, stock splits enhance liquidity. With more shares available, stocks become more liquid, meaning they can be bought and sold more easily without significantly impacting the price. Thirdly, stock splits can generate positive market sentiment. When a company announces a stock split, it often creates excitement and optimism among investors, which can lead to increased trading activity and higher share prices. However, it's essential to recognize that stock splits also come with potential drawbacks. Firstly, stock splits don't necessarily increase a company's value. It is crucial to remember that the total value of a company doesn't change during a stock split. Investors should focus on the company's fundamentals rather than making decisions based solely on stock split news. Secondly, stock splits can sometimes lead to volatility. The hype surrounding a stock split can cause share prices to fluctuate wildly, creating uncertainty and potential risks for investors. Now, it's also essential to consider the difference between forward and reverse stock splits. As mentioned earlier, a forward split involves increasing the number of shares and decreasing the share price, while a reverse split decreases the number of shares and raises the share price. Reverse stock splits are less common, but they can signal that a company is facing financial challenges, leading to concerns about its future performance. In conclusion, stock splits are a fascinating aspect of the stock market that can significantly impact both companies and investors. Understanding how stock splits work, the reasons behind them, and their potential pros and cons is crucial for making informed investment decisions. As we've covered in this video, stock splits can make shares more affordable, increase liquidity, and boost market sentiment. However, it is essential to remember that stock splits don't change a company's fundamental value and can sometimes lead to volatility. By staying informed and focusing on a company's long-term prospects, investors can navigate the complexities of stock splits and make smart choices for their portfolios. Thank you for joining us on this episode of Level Up Finance. If you found this video helpful, hit that like button and share it with your friends. We'd love to have you back for our next episode. And if you haven't already, subscribe to stay updated on all things money, business, and success. See you next time.